Good morning. My name is Roy Thompson. I head up Carpenter Box Financial Advisors. I'm joined with me today by James Giblin. James is an investment manager at LGT Vestra. And in this latest update, just really wanted to focus on perhaps some of the investment decisions that LGT Vestra as an investment house have made in recent times. We've spoken before, James, about the potential implications of inflation, and looking at investment markets in recent weeks, there's been some volatility and a lot of that predicated by the fear of inflation, as we've discussed before. So, will this be a short-term trend or more of a longer-term trend that then forces central banks to put up interest rates, which of course is I think still a concern in the background, or the major risk that we might face moving forward. I think you were saying there before came on the call that you as a house have made some recent investment changes. Do you want to just talk through perhaps what you've done and perhaps what the rationale for that is?
Yeah, of course. So just touching on inflation and the figures that we've seen recently, it's very much been our house view that inflation figures would be high, particularly in May. A couple of the reasons for that. So obviously this time last year, oil prices were negative. At that crazy period where we saw spot prices going to almost negative $40. So some part of the increased inflation figures are those base effects. So last year, these prices were really low. And if you compare it with this year, when you've got a more normal level, inflation figures obviously look high. And another thing on inflation, a lot of the inflation figures were concentrated in certain areas. So used cars for one, and a lot of the areas, the sectors that have been opening up and have a lot of demand. So not just a straightforward picture on inflation, quite a complex one where some areas are experiencing a lot of inflation and others aren't. But in terms of how we're looking at portfolios recently, we have moved more active. It's both in equity and in the fixed income space. And the reason for this, over the last year, we've seen markets and equities all move up together or all move down together. The whole conversation has been around the pandemic, vaccine levels, case numbers. So it's very, very much been everything's gone up or everything's gone down, and correlations have been very high. And what we're seeing now is the correlations coming down quite significantly. And what this leads to is great opportunities for active funds. So whilst we do understand how passive funds are often very good in portfolios, particularly in markets that are efficient, such as the US, we believe that now is very much a stock picker's paradise, and that moving towards some of these funds that are a bit more active and can find these really good quality companies should benefit the portfolios.
So there's a lot made, just to pick up on some of the terminology used there. There's a lot made or a lot written about passive investments versus active investments. So just to be clear here, for those listening in, your portfolios have a mixture of passive and active funds that you select to try and generate a return. What you're saying is that in certain areas you might be moving away from some of those passive funds to a more active arrangement. And that is because you see that the kind of outcomes, if you like, from the pandemic are a little bit more binary than they have been in recent years, where things, as you've just said, move either up or down in the same direction. So that might be that word correlation. So we can have two different shares listed on the US or the UK stock market, and one does particularly well and one does particularly poorly. Historically, or in recent times, they've either all done well or all done well, or all done badly, sorry, and that's because of the sentiment around the pandemic, certainly in the last year or two. That would be the position. Is that a fair sort of summary from what you've just said there?
Yeah, I think that's fair. I think also what you've seen in the US, where over the last year we have had a lot of passive exposure. Some of these big names in the US, so Facebook, Amazon, Microsoft, Alphabet, these are huge parts of the index and will make up a huge part of a passive fund. They've done incredibly well, and whilst they're great businesses, the valuations are looking somewhat stretched. So we're taking the opportunity just to reduce our passive exposure move out of some of these really big names that have done very well, move down the market cap spectrum, so smaller companies, more exciting companies, a lot of companies that have a sustainability play. So one of the funds that we added is a sustainability fund. But again, we're not adding it to make our portfolios more green per se. We're adding it because we like the companies that it invests in. So yeah, in terms of the active passive debate, when markets are more uncertain and maybe we're going to move up and down, if you can pick these good companies, these winners, we believe that good quality fund managers can genuinely add value in these kind of markets. And whilst there's always that debate over active versus passive, can they really add value? We believe that there really are these managers out there that can add genuine outperformance. We spend a lot of time researching managers, which is why I believe that there are some circumstances where an active manager can add genuine value, such as now.
Mm-hmm. And by moving down that market cap, you're expecting that you would achieve, or you would extract some growth from that area to a greater extent than simply holdings or some of the the big or the large market capitalized stocks such as Facebook, etc., as you've just referenced. So is that just an equity position then, or are you looking at doing that in other asset classes as well?
Yeah, so we've also moved more active in our bond space. We are typically quite active anyway in how we move our fixed income positioning around. So last year during the pandemic, we added quite a lot to investment grade fixed income. So really good quality companies. They were getting a huge amount of support from governments. So governments were buying all these kind of bonds. So AAA, AA, all the way down to BBB rated companies. So these are good quality household names. So companies like Unilever, Diageo, these kind of companies that are really solid. What we'd seen is you were getting paid a lot more to hold these bonds. So spreads had blown out quite wide. But we saw them as still incredibly good quality businesses being supported by government. So we decided to go out and buy a fund that buys a lot of these investment grade, good quality bonds.
Okay.
Over the last year, we saw the spreads really tighten. We made about 10% on this position, and we've recently decided to sell it. Spreads are a lot tighter, so you don't get as much for your money for holding these companies.
Yes.
And what we've done, we've moved it towards a more active fund manager, and they can buy all. They're not focused just on investment grades. They can go out and buy emerging market debt if they want to. They can buy government debt. So what they're looking for is volatility in the market and mispricing. And how this helps us, it's a diversifier for the portfolio. So it's less correlated with the rest of it. And with added volatility comes added opportunity for this kind of fund. So we decided to move more active, both in fixed income and in equities.
So for those listening at home who might be invested in this sort of way, is there a notion where you're sort of, if you're moving to smaller companies, so more moving in the equity space and looking at a wider spread of bond holdings that aren't just investment grade, is there an increased risk in portfolios, or how are you managing that position?
So first, on the equity side, the companies that whilst we're moving down the market cap, we're increasing the quality. So these are really good businesses that we're buying. So one of them is Nike. One of their top holdings is Nike. There's also companies like Apple in there. So again, it's still one of those big names, but one that we really like, and one that we think will continue to outperform. So whilst we're moving slightly down in terms of company size, the quality of companies has increased. And that's typically what we've decided to do in the portfolio. Is we haven't gone out and bought these value names, these more cyclical names. So we're not going out there and buying airlines. We're not going out there and buying miners. A lot of these companies do look cheap, but we think they're cheap for a reason. There's going to be bumps in the road as we move forward. So instead of going out and buying these more cyclical names, we're buying slightly smaller companies, but good quality businesses. That's how we're playing this kind of opening up trade, rather than going out there and buying these more deep value companies.
Yeah. Okay. So if we were to summarize this, then off the back of the pandemic, and as we, the vaccine programs continue to look fairly successful, certainly in sort of westernized economies, you have a scenario where there's going to be lots of bumps in the road, and off the back of that, you're moving your portfolio slightly away from some of the passive holdings you've had to more active management, because you believe that there is an opportunity for those active managers in a sort of volatile space to try and make more money, or to try and outperform the indices. That position would be kept under review. So it might be in time that you change back, but just where we are economically at the moment, that's the position that LGT Vestra are taking. So I think that's been really useful, James, and just again a rationale for how you're approaching investment management and why you're making the decisions you are just at the moment. So I really appreciate your time today, and thanks for coming on this morning. Thanks very much.
Thanks, Ray.